Hey, so this is our second part of our conversation with Joe Czempoyesh. If you think of any questions while you're listening, just let us know and we can try to get you in contact with Joe.
Okay, stepping back a little bit again, we also talked about maybe someone who sort of changes gears partway through their situation. They were more conventional buyers. They have their principal residence. They were taught, by their parents, pay down that mortgage as fast as you can, which was probably good advice back in the '80s, right? When the interest rates were crazy high. But now they've come to the realization, okay, that's not the way to go. I've changed my mind. I do want to buy more properties, investment properties, in addition to my principal residence.
Yeah.
So where should they go? I think you mentioned to me
Okay.
before the possibility about drawing all their equity back out, or as much equity out of their house as possible,
Right.
to get rolling on their first investment property.
Yeah. It kind of refers to the term kind of lazy equity. Like you have lazy equity in your home. It's money that you have that's in your home that's doing nothing. And we have intelligent use of equity or intelligent use of debt. And and really it's fascinating when we look at this because a lot of times we come from our parents were from you know Portugal, Italy, Scotland, like different places, and they were kind of they just don't believe in debt at all, right? Pay
Yeah.
down the house. And there's a lot of sayings out there, right? Paying off your house is harmful to your net worth, kind of thing, which is a funny way to say it. But let's look back exactly at what you said. You're in the '80s. Interest rates had gotten to 22%, back in the early '80s. But you could buy a house that we would pay $750,000 for today for $60,000 kind of thing, right? So let's say that you had that house in the '80s at 22%, and you decided to leverage it by in borrowing as much out of it as you could. Today we can go to 80% of the value. Let's say you paid down that home in the '80s at 22%. That was worth $60,000, and you had it paid down to the point where you could borrow back, and you borrowed back at those high interest rates, and you bought another property. And let's just stop it there. One house you had that you paid down instead of having leveraged it up and have two houses, right? Well, that house today, let's say, is worth $750,000 and you've got no mortgage on it, or you have that other house, if you're still alive, which you probably are. You have two houses worth $750,000. You have $1,500,000 worth of real estate versus $750,000. And yeah, was it a struggle to pay down that debt back in the '80s at 22%? Yes, it most likely was. But I think therein lies a little bit of the secret sauce with investing is that, you that forced savings, that forced payment, you got into a situation, and it may or may not have been a little harder because the rents always kind of offset the payments. So we're seeing that today. Rates are through the roof, property values are through the roof, rates are really low. So there's always a balance in there, but you leverage the property, you pull out that money. It's intelligent debt because you're reinvesting, and the secret sauce of it is the forced savings of the principal pay down of more than one property than just that one property where the equity sits in there dormantly, doesn't do anything for you. It's just
Yeah.
sitting there, right? And if you're of limited means and you can't afford to pay any debt, that's another story. But we're typically not talking to those people. We're talking to investors. We're talking to people that want to grow their net worth and build for their retirement. And going to that is that when we set up properties and people have their principal residences and they're paying down that debt, the way that I really like to set that up is we either increase the first mortgage on the property, or we throw a home equity line of credit on top of the current mortgage that you have, which is something we'll have to talk about further because it's sometimes a little difficult to throw one on top of an existing mortgage from one bank to the other or one lender
Okay.
to the other. But technicalities we can tackle at another time or in another question. But pull that equity out, and that's intelligent debt reinvested in the market, and always have that ability to tackle or take money out of the primary residence is always going to be your cheapest option for mortgage debt, right? So the ability to tap into that, take that lazy equity out of the property and reinvest it in the marketplace is really what we want to do. So again, circling back to the question, whether you're a first-time home buyer, whether you have 3, 4, or 5 properties, whatever you are, right? You know, taking the money out of your, maybe the primary residence or maybe one of the other properties that you have as well, and using the equity that we have in our homes, instead of have it be lazy equity and doing nothing for us there, and redeploying it into the marketplace and putting it to good use so we can make a return on that equity, right? That's really what we're talking about. So again, we can go back to proper setup from the beginning, you know, where, and this is where we get the lines blur a little bit. Hey, on one hand, Joe says, don't pay down your mortgage very fast, right? Well, we're not really saying that. We're saying make the minimum mandatory payments as low as we can get them so that on paper, it doesn't affect your ability to borrow going forward, right?
Yeah.
But we can always pay that equity down. We have some extra money, we can pay it down, right?
Yeah.
Take our money, take our after-tax dollars that we've earned, pay down that mortgage, right? Behind the scenes, so to speak, with their every lending institution allows us principal pay downs, right? Typically 15 to 20% per year, right? Pay that down, or right out of the gate, we can set it up as a line of credit and a mortgage. And as we pay down the mortgage, the line of credit that we have increases, the ability to borrow increases, right? Yeah. And then we use that equity in the home, which is leveraged, we're borrowing it, right? To buy the next house. And that's tax deductible. So we also get into taxation. Favorable taxation is a big point that we need to talk about as well, right? Because you're really, at the end of the day, you're trying to increase your net worth and the value you have, and this is, you know, how we do it. So proper setup. Sorry, I bounced around a little bit, but it's all all this stuff is weaved together, right? Yeah. We weave together a proper financial plan so that whenever we go to do something, we're doing it correctly to increase our probability of success going forward, right?
Yeah.
So
that makes sense.
I hope that answered the question.
So watch out for the next part of the video series, and hopefully we'll get that to you soon. Thank you.